So, hello and welcome to another Impact Insights. I'm really delighted today to have with me Pepper Money, Bluestone Mortgages and Precise Mortgages. We're going to go through a number of questions that have been raised over the last few weeks when we've been talking to brokers and also customers as well, just to see what's happening in the marketplace with regards to the adverse sector, the self-employed sector, contractors, and a bit of technology thrown in as well. So hopefully the next 45 minutes or so, you'll find it very useful, and we will try and cover as many aspects as we can. But I think probably the first best place to start is with who I've got on the panel here. So Daniel, if we can start with you, please. Can you just tell us who you are and what you do at Pepper Money?
Yeah, thank you, Dale. So my name is Daniel Wraith and I'm the National Development Manager here at Pepper Money. So my role is to ensure that we build and maintain those strong relationships with the likes of Impact. So when you find a case for us, we pull out all the stops and give that VIP treatment.
Very good, thank you. And Charlotte from Precise?
So I'm Charlotte Parker. I'm one of the BDMs that covers the South Coast. I look after the long-term lending, so your residential buy-to-let side of things. The key thing for me is that brokers can feel confident to pick up the phone and discuss any new cases they need to with me. So again, the relationship's really important.
Excellent, thank you. And Mark from Bluestone.
Thanks, Dale. Yeah, so my name's Mark Todd. I'm the Key Account Manager for the South at Bluestone Mortgages, and my role is to manage the relationships with all our kind of biggest supporters and become the first point of contact for any kind of new business or relationship issues that may arise.
Excellent. Thank you, everyone, for that. So let's just start very generally at the moment. The market has obviously, we've come out of 18 months of an interesting scenario, and obviously COVID is still very much in the process. But how have you seen the last few months with regards to volumes, and where do you see the end of this year going? And let's start with Charlotte on that one, please.
So I think we've seen a bit of a slow in the market, certainly since the stop of the stamp duty change. And I think what we've seen with swap rates increasing, perhaps rates should have gone up. I don't think we've really seen that in the market. I don't think lenders' lending levels in general are where they really want them to be. So I think that's why we've seen the rates come down. I think as we go into next year, I think there'll be certainly some change, so from Precise's side of point of view, when it comes to criteria. So we've been moving up through the gears as we've come out of the pandemic, and slowly as confidence is growing, I think we will see an improvement towards next year.
Yeah, I think the confidence level is a real high at the moment. Daniel, what about yourself? What about Pepper? How have you seen things over the last couple of months?
Yeah, so very similar story to the one that Charlotte's just shared with us. We've seen a slight falling off of activity, especially around purchases at the end of that stamp duty. But it's a perfect storm, really. It's collided with the sheer amount of remortgage activity that's going on in the market and those high number of attestations that we've seen. So we've seen a real switch from purchase to remortgage activity. And that's where you've seen the likes of us launching for the first time ever Pepper 60 on residential to really help find a home for those cases that maybe just falling off high street and need that remortgage solution.
Okay, great, thank you. And Mark, what about Bluestone?
So I think it's a really, really good question. It's quite an interesting topic, really, because we've already kind of touched on what Charlotte mentioned with the whole stamp duty deadline. Kind of felt like everything came at once. It seemed to slow down, but then that kind of coincided with the country basically opening back up with the end of like the proper lockdowns and summer holidays and stuff like that as well. So we had a bit of a slowdown, but we're back to kind of where we was kind of just before the stamp duty deadline from an applications volume. We've just gone whole of market for Help to Buy and launched into the Right to Buy market as well. So I think there is still a big demand for mortgages, and I don't think the market's going to go completely dead. But I think we do have to kind of look at the kind of lack of housing stock that's kind of out there as well at the minute. I believe there has been some figures flying around as well around the fact that there isn't as many kind of houses as there were kind of this time last year or even pre-pandemic. Although interest does remain quite high.
Yeah, I think the whole, I said just a minute ago, at the moment, confidence is massively increasing across the marketplace. And I think a lot of people right now are exploring their options, maybe not for today, but actually for what's going to happen over the next 12 months. They don't want to carry on renting, they want to buy their own property. And I think you're right, there is a shortage of housing stock, but also the stock that is around, you've got 10, 15 people looking at every single property at the moment. So it's a very competitive entity. So let's just start with, again, like I said, the last 18 months have been pretty horrific for some people. Adverse is most definitely on the increase currently. What are you doing? What are you helping? Or how are you helping clients in that sector? Let's go back to Mark on that one, please.
So over the past kind of 18 months, we've actually seen our business massively kind of increase as well. And one of the things that we found was we didn't have to kind of change our criteria too much to ensure that we could help this new kind of group of disenfranchised customers. But the big focus for us has always been about kind of getting people to get themselves kind of repaired and head back towards the high street, whether that is from the criteria standpoint around self-employed. So obviously we've got our COVID repair self-employed policy, which enables us to almost skip the most recent year's SA 302 and work from the pre-pandemic levels. Obviously there's a bit more to it than that, but ultimately that's a really good support network for people who have been impacted, who were self-employed. And our general adverse criteria has always been quite strong, looking at what we can handle, whether that is kind of recent defaults, CCJs, IVAs and bankruptcies. And what we've seen is that there almost doesn't seem to be a huge need to tweak that. We're just seeing more people naturally kind of falling into these categories. So ultimately, we're still, main focus for us is still going to be help people get that credit repair and head back towards the kind of high street. And there's a lot of things we've got kind of in the pipeline coming down to what we can do that over the next year or so. But for the meantime, it's all about helping those immediately affected through our kind of adverse policy, criteria on completion, and just making sure that anyone who feels disenfranchised isn't, and that they do have somewhere to go and someone to help them.
I think a lot of people have sort of buried their head in the sand, really, and hoping that this will go away, or their existing lender will help them, even though they've just had a default, or in some instances, we've had issues where they've actually had a mortgage payment holiday and have still been declined by their high street provider with regards to even the mortgage missed payment was agreed in principle as a holiday period. The credit search agencies can't provide that as a payment holiday, and therefore the tech-orientated high street guys can't see it as, or just see it as a missed payment, and therefore they haven't been helping people. But Charlotte, same question to you on that one, with regards to the adverse side of things, please.
Again, as sort of confidence levels have improved throughout the pandemic, or toward the end of the pandemic. So we've returned to the market now, certainly on residential cases. We're looking at up to 2 defaults in the last 24 months and 1 CCJ in the last 24 months. So there are a couple of limits within there. Those that maybe have had the blips, as you mentioned there, Dale, we can look at status 1s in the last 12 months. So, we are able to service that sort of market. So the key thing for Precise when it comes to adverse is we need to see that they have actually turned a corner in the last 3 months. So we're looking at those bank statements, making sure that, the last 3 months, it's sort of, there's no adverse registered more recently. But we are still able to service those that have had those CCJs and defaults within the 24 months. So yeah, I mean, I don't think that's, we did change a little bit at the beginning of the pandemic. As I say, once the confidence levels improved, we were back sort of out there again, still not quite returned to pre-pandemic levels, but I think that will, you will see us return to that, I think, towards next year.
Okay, that's cool. And with regards to the missed mortgage payments, you're quite happy to do 010101, and that will just be classed as 1 missed payment rather than 3, isn't it?
Absolutely, yeah. So if it's, we're looking at 3 zeros in the last 3 months. So when you're looking at those credit files, yeah, it could say 01 or a few 1s in a row. What some brokers will do is add those up and count that as a 3. Well, that's not. It's just a status 1. So we're looking at worst status 1 in the last 12 months on residential cases. And I have had a number of conversations where that has been the case, where the lender that they've taken a payment holiday with has registered it. And then, of course, the high street are saying, no, we aren't able to take a view on it. So, yeah, Precise is certainly picking up that sort of stuff.
And I think payment holiday was completely the wrong terminology for it. It was obviously a deferment, but people just thought, well, hey, it's free money for a few months and I'll take it as a holiday. What they don't realise, and from a broker's point of view, we need to be ready now, because we're going to see a lot of this over the next 24 months. If it's starting now, this is quite early into the mix. You know, people are coming up to the end of the 2, 3 and 5 year fixes over the next however many years. This is going to impact them, and they need to be aware that yes, payment holiday happened, but unfortunately the high street guys can't, most of them can't, and their systems won't allow that to be recognised as a holiday. So Daniel, I'll unmute you on that one. If you can unmute yourself, thank you. Same with you, adverse, obviously huge increase with Pepper and the various bits over the last few months. How have you seen it, and what are you offering to clients at the moment?
So adverse is it's obviously our bread and butter. So very, very simple approach to your CCJs and defaults. We don't require them to be satisfied, and we've got no volume or value limit, and that's maintained, and we've maintained that proposition all the way down there on Pepper 6, meaning we've got opportunities for your customers who've had those blips as little as 6 months ago. But what we are seeing is that it's still sort of in that middle 24, Pepper 24, Pepper 36, where we're seeing a lot of the business still coming in. So definitely we've got solutions, and we're still committed to those people who maybe have those bumps along the way. And because we have that manual underwriting approach, everything's manually underwritten, we can apply a real human approach to it as well. So there's no systems making any decisions.
Which is great, and that's exactly what we need in the current climates, especially with regards to credit scoring, which we'll come on to a little bit later. But Dan, just staying with you, rates from starting with a 1, I believe.
Yeah, so we've got rates starting at 1.98 at the moment on the Pepper 60 residential. So again, that's us providing opportunities where maybe the high street's just fallen off ever so slightly, again because of these blips, or even just the way that they're considering income, bounce back loans, bits and pieces like that. We've got a solution now for them where if they need that manual underwriting approach, we can potentially take something that might have necessarily gone high street before.
That's a really good point. So adverse starting with a 1, it's incredible. Okay, so the high street guys are most definitely coming back into our area. And our area being sort of small blips, the odd CCJ and default ignored under 250 quid, communications defaults ignored under £300, and so on and so on. How do you see that as a threat to your own entities? Charlotte, let's start with you on that one, please.
I think the high street and the specialist world, certainly over the past 12, 18 months, is the lines have been blurred a little bit, but the question is whether or not the high street will sustain that. So I think they've had to move into that market just because of the world perhaps that we live in. I think certainly where Precise will sort of fit within that, when you're credit scoring, it's going to pick up those cases that perhaps the high street aren't able to take. It's a little bit too much. It's £251, for example, using your example there, Dale. So with our credit scoring, when it puts you into that tiered system, so you've got a chance, a 1 in 4 chance of getting a yes decision. And when you go to high street, it tends to be a yes or a no decision. So it can be useful to have a specialist lender in that place that will tier you and that will give you different options.
Okay, great, thank you. And Mark, what about yourself? Any threat from the high street for you guys?
I don't think so, if I'm really honest. I mean, if we look at what we do as a lender, and with such heavy adverse and taking on people who might be just out of bankruptcy or current IVAs and stuff like that, I'd be really surprised if we saw kind of the high street come down and go for those types of customers, to be honest. So, don't get me wrong, maybe on the slightly cleaner stuff, they might pinch a few from certain lenders, but although we do a lot of kind of clean cases, we've never been a lender who people would go to for just something that happened 4 or 5 years ago. It's always been something that's a bit more recent and a bit more heavy. So from us as a standpoint, it's great to have more customers who've got options, but I personally don't feel like it's going to damage us too much at all.
No, fair enough. And I think from your side of things, I think we're going to see a much more of an increase in customers who have taken an IVA out over the last sort of however many years, because it was the right thing for them to do at that time. Bankruptcies we're not seeing so much of just recently, but I suspect we'll see more of that as the last 18 months come into play. But a lot more recent missed payments, I would say, is probably our biggest issues at the moment. So seeing missed payments over the last sort of 6 months, maybe, and not just one missed payment, we're talking 1, 2, 3, and so on, which wipes out a lot of the high street lenders anyway, because once you go to a 2 or 3, they're out. So
exactly.
But I think it's also a massive opportunity for you guys right now, all 3 of you, to be honest, to provide something for clients moving forward over the next sort of 6 months or so. So are we doing enough to help those? Are we doing enough to get out and educate those who have had problems since COVID? So they may have just come off furlough, they might be made redundant, they may have not had enough money, or whatever else, and therefore they haven't paid a bill or 2 over the last sort of 6 months. Are they burying their head in the sand? Do they know that you guys are available? Are we doing enough to educate that entity? Dan, what do you think on that?
So education, I think, is key. I think it works both sides, both from an intermediary perspective and also from a consumer perspective. At Pepper, we commissioned the adverse credit study, and we'll be launching our most recent one in coming weeks. But again, it's telling very similar stories, that there's misconceptions out there, that people who've had these blips feel that it will exclude them from the market, which we know is completely inaccurate. And there's still that stigma as well, I think, from consumers feeling that they don't want to come forward and be honest, almost, whether that's that they're telling the brokers little white lies when they're sat in front of them to make them appear more creditworthy than they are. But we don't need to be we don't need to be in that world, and I think that's the key. I think we need to talk more about our circumstances, and I think there's lots that brokers can do to help educate the customers and make them feel comfortable in coming forward as well, because these are the people that need specialist advice, and Money Supermarket's just not going to cut the mustard, unfortunately.
Thank you. Charlotte, what do you want to add to that?
So I think I agree with Dan there. I think education is key, and I think, you know, the pandemic has enabled us to kind of look at the way in which we interact and speak with brokers. And I think having the ability to hold Zoom calls, you know, this kind of thing, wherever you are in the country is vitally important, especially when you're trying to educate brokers on some of the changes maybe that have happened in your criteria, you know, and just some reminders around the ways that we can help and the solutions that we've got in the specialist market. I think Precise have done something around 8,000 brokers have attended some of our educational webinars over the last year, and I think that's huge. You know, some of the education that we've provided has been you know, vital for some brokers staying afloat and actually, you know, having 10 cases on their desk that they've been really struggling to place because, you know, they just don't know where to go with it. So I think education massively is really important. And again, you know, you're right, Dan. I meet so many, you know, friends, family, colleagues who have said, I don't know what to do with this. I don't know if I can get a mortgage. I don't know if you know, if I can actually buy somewhere or move up the ladder, whatever I want to do. And I just think it's really important that they do go and speak to a broker, because, you know, quite often they'll go direct to their bank. An example, one of my friends did exactly that, went direct to the bank. The bank declined them. They didn't tell them they declined them for around 3 weeks. And I'd said to her right in the beginning, you know, you need to see a broker. You need to see a broker. Go and get their expertise. And eventually she did. And, you know, she moved in 3, 4, 5 weeks later, which was amazing. So, yeah, I think education is massively key. And you know, the relationship with the BDM, I think, is more important now than ever. And it's just running those sort of tricky cases through and picking up those bits and pieces that perhaps, you know, weren't a problem 18 months ago, that you would know. I've got a self-employed client here, and I've got a couple of years figures and it's in a downward trend. Well, Precise would take an average in a downward trend, but are they still doing that? Yes, we are, but it's that broker pick up the phone, giving us a call and talking those cases through. So I think the role of the BDM is certainly really important.
That's a really good point, Mark. Just before I come to you, I think that's an excellent point, because I think we've really seen the value of the BDM and the power they have within their own companies over the last 18 months, trying to get things through when underwriters have been working at home, so they haven't been able to see people face to face, haven't been able to run something past their manager, and so on and so on. So actually, the BDMs that really have shined over the last 18 months have been those that have actually been able to get things changed, challenged through that maybe, you know, a lot quicker than normal, etc., etc. So yeah, I think you're right. Some people would have shined over the last 18 months, and some people certainly did not, as far as I'm concerned, from our point of view as well. And those will be the ones that are invited back in the office. And if you haven't got an invite back in the office yet, then you may well have been one of the ones that didn't help the team out. But it's all about, you know, relationships and communication at the end of the day. So I think that's a really valid point. Mark, over to you.
Yeah, so no, education's key. I think everyone kind of, especially myself and some of my friends, people in my age group, we didn't really get an education on the way finances really worked when we were kind of growing up and stuff. So if you miss payments on a credit card, you didn't think it mattered, like, and no one ever told you anything differently. And you know, there is also a big push from us, from a lender, and I think we've all kind of touched on this already, but educating brokers on what we can do to help them is key, because we're not customer facing. We only deal with, you know, packages or brokers coming in directly and stuff like that. So we never touch the customer. It's all down to everyone else. And our job from an education piece is to make sure that brokers know what we can do to help their customers. But as well as that, make them not just understand our policy, but make them feel comfortable, because a lot of them might have only ever dealt with kind of high street and stuff like that. And especially if you're new and you're a fresh broker, like it can seem intimidating, especially with, you know, some high street lenders getting offers out in half a day, only asking for one pay slip and kind of things like that. And then you move into specialists and there's more documents and things take slightly longer. It can be intimidating. And I think as specialist lenders, we all bear that kind of responsibility to educate brokers, to get them to understand that specialist or complex credit or adverse, however you want to call it, isn't something to be scared of. You know, it is something that everyone should be looking at, and everyone should kind of be, you know, gearing their businesses toward, especially over what's happened over the last 18 months. Because whoever you, one of the milk self-employed customer who may have never had any adverse or anything like that, it would always be an easy fit on the high street, nationwide, NatWest, or whoever, you know, no longer might fit that mold. And if you're not used to dealing with specialist lenders, what are you going to do? You're going to say no? You're going to hand it off to another broker? Or is that customer going to feel like they can't do anything? So, you know, I think going back to your original point, I mean, education is absolutely key. Well, it's a responsibility that we all bear to make sure that everyone knows that moving forward, these people do have options.
Absolutely. And are brokers doing enough right now to learn about specialist lending? Because I think there's a lot of people that have been very set in their ways with the high street lenders, Nationwide, Santander, Halifax, etc. If it doesn't fit them, then they may even hand that client off, or even say they can't help them. Are you seeing an influx of people now, brokers more than ever, actually learning about the specialist lending side, because it is something that's going to be rapidly on the increase over the next couple of years? Charlotte, over to you on that one.
Yeah, I mean, certainly when I became a BDM, you know, nearly 3 years ago now, having come from the broker world, it is a two-way street. So, you know, you kind of have to put your hand up and say, look, I need to know more. I want to learn. I want to improve. I want to be able to help everybody. I think there is a solution for, you know, pretty much every customer that comes in. It's whether or not they're prepared to pay, you know, not the 1% potentially, or you know, whether they might get a 6%, for example. You know, it's whether they're prepared to pay for that product to get what they actually want. But I think certainly when I first became a BDM, there were lots of brokers who perhaps had done it for a long time, you know, been a broker for a while. They thought they knew everything. You know, and I think there's one thing that we can all agree. I mean, I've been in the industry 21 years and I'm still learning. You know, no 2 days are the same, and there's always change. There's always change in regulation, change with lenders. You know, that's one thing we can guarantee, is that nothing will stay the same. And I think you just need to be open, you know, and want to learn. I quite often get brokers call me up and say, you know, oh, you know, you mentioned something about limited company buy-to-lets the other week. Can I just pick your brains on something? And you think, aha, something has clicked, and they've had a case and they now want to learn more. And I love that. I love the fact that brokers will call me up and say, can I pick your brains on a case? I'm not sure if it's a precise one, but can you just tell me how you would view this and what would I do in this event? So I think, you know, I think there is more of an appetite for brokers to learn. You know, events have started back again, and I've seen the turnout. I was at an event last week. The turnout was absolutely brilliant, and some of the questions that the brokers were asking were really, really good. It wasn't just a ransack your stall to get a load of stationery to take home. There were sort of some really valuable conversations and that were happening. So I think there is more of an appetite for education. I think more so now than ever, brokers really need to kind of diversify their lenders. You know, so if they've always only ever dealt with 5 or 6 different lenders, they know what they're doing. I think, again, the role of the BDM is really important, because sometimes we need to hold that broker's hand, and we need to hold that packager's hand and say, look, don't worry, this is what it's going to look like, this is how it's going to feel, this is the process. And also forewarn them, you know, these are sorts of documents that we're going to need, you know, our SLAs are this, so just preempt it, you know, prepare the client and let them know that it may take a little bit longer, but we will get there.
That's a really good point, thank you. Dan, what do you want to add to that?
Yeah, absolutely. I think we are seeing an increase in brokers wanting, and intermediaries in general, just wanting to learn more about the specialist space. I think the days of being scared of it are starting to dissipate, certainly from our perspective. If you were to key a case through with us, we use DPR, or Finova as it's now called, but it would be the exact same process and same look and feel, other than a few changes in some radio buttons. But you know, if you're not comfortable doing it still, then definitely there's people like Impacts that can just pick that up and take that away from you. If you're too busy to educate yourself, then if you're going to take anything away from today, it would be to find yourself a partner that you can work in partnership with to pick up those complex cases.
Good point. And as we move on to complex cases, let's talk about the self-employed. So the press has sort of suggested this is one of the more underserved areas, and to be honest, we've dealt with the self-employed since day dot 30 years ago. We've been going, and you know, it changes all the time, but the crux of it is still the same. However, obviously after the last 18 months, a lot of people have been made redundant, got out on their own, and so on. So where do you sit with the self-employed? What criteria do they need to meet, and how many years figures do they need to work on calculations? Mark, over to you on that one, please.
Yeah, sure. So we've actually got kind of a 2-tranche self-employed kind of way we look at things at the minute. And I touched on it a bit earlier about kind of COVID repair policy. But I'd go with the standard flat rate to begin with. So we use the latest year's figures, and we need a minimum of kind of 12 months trading. Now, if you were impacted by COVID last year and your 2021 figures aren't amazing, and your previous pre-pandemic figures were a lot better, and you're now back on track, we can work from those previous year's figures, as long as it can be evidenced that, you know, you are back on track now via your business bank statements or your personal bank statements, depending on the way you're set up. So I think that's a really good, you know, support network for self-employed people. And I think we may have been one of the first lenders to come out and kind of bring something like this into market. I know a lot of people have followed suit, their own little spins and twists and stuff like that with it, and it's great. And I think it just kind of goes to show that there's so much support. And again, going back to the last question on education, there's so much support and stuff that everyone's kind of bringing together to make sure that these people are being supported and are being kind of given the opportunities that they would have had pre-pandemic.
Brilliant, thanks. Charlotte?
So I think one of the misconceptions is that Precise is purely an adverse lender, and it's interesting when we get some statistics through that there's only around 8% of our business is adverse, but actually around 20% of our business is self-employed, which is really interesting. Now, throughout the pandemic, Precise didn't really change their stance on self-employed. We've always been able to take 12 months trading. So you could have someone that perhaps they were an employed chef that was furloughed and decided that they wanted to branch out and become a DHL delivery driver or Amazon delivery driver, and they've now got 12 months trading under their books, and that's just finished in October. So we don't even have an SA302 yet, but we have got accounts, so we can take on the raw SA302 accounts. So and And I would say those sorts of clients who perhaps are in that category where they think that no one can help. You know, I've only been doing it 12 months. What can I do? It's a completely different role. I was a chef before, you know, and I haven't got a projection because I don't know what next year is going to look like. So those are sorts of customers that Precise can help with. So changing role, you know, completely different line of work. I could have been a bricklayer before, and I'm now a self-employed ballerina. You know, completely different line of work is fine for us. When it comes to 2 years of trading, let's say the more recent year was a lower figure, most lenders are going to take the lower figure, or they're going to say, no, thank you, you're not for us. Precise have always been able to average out in a downward trend. So again, that's not really changed. If you flip that around, say last year was a lower figure, this year was more higher, we're going to be able to take that highest figure. So it's a little bit more generous for the customer. The key thing for us is those bank statements, is looking at the last 3 months bank statements and seeing what income's coming in now. So a bit like Mark was saying, you know, we just need to see what they've actually got coming through those personal bank statements now. When it comes to your directors, so we've always been able to add things back in, like a car allowance or even a pension contribution. So again, we're sort of looking at just being a little bit more generous and understanding the self-employed a little bit more when it comes to looking at their income figures. Where you have got those that have taken maybe SEISS grants or business bounce back loans, things like that, if their business has been affected by COVID, and let's say last year their figures were 30 and this year their figures were 30, but we could see in that SA 302 that they'd taken the SEISS, then we're good to go with that, as long as those last 3 months bank statements kind of look like around about 30. If, however, they've taken the SEISS grant and their figures have inflated, it's kind of not really in the spirit of what the SEISS grants were there for. So we'd probably still be looking to take the 30. But I would say in any of those sort of cases, always speak to the BDM, you know, and have a conversation around what that looks like. If there's bounce back loans in there, so if you've got, you know, sort of limited company directors who've taken the bounce back loan, provided again it's not being used in the spirit of things and they're going to try and use it as a deposit, because that isn't something that we're able to consider, then we're not too fussed on that. And when it comes to the paying of it back, again, if it's limited company, it's a business cost, so we're not taking that into account for affordability. But yeah, I think, you know, there's a few pointers in there that will hopefully help the self-employed. But again, Precise haven't really changed their stance on it throughout COVID. We are, an important thing to say is that we are still taking 2020 figures. So if you haven't quite got your 2021 figures yet, we are still taking 2020 until the end of December this year. So I've picked up a few cases this week where that's been quite useful.
Useful to know, absolutely. And Dan, over to you on this one.
Yeah, so we've got our flag very well placed in the sand as well for self-employed, and we've got real commitment towards it. So very similar, we work on 1 year's trading accounts. We don't require them to have been in a similar line of employment prior. As long as the accounts are finalised, we're good to go on that. For your controlling limited company directors, we can add all the add backs in as well. So very much treating them like their employed counterparts. And again, we're working on 2020's accounts, so yeah, it's something that we can help with until the end of December too.
Brilliant, really useful. Thank you for that. Staying with you then, Dan, on that one. So income multiples are pretty tight at the moment across the board. They've obviously been restricted since COVID. We're seeing some high street guys come out with a little bit more here and there. What's your views on income multiples and affordability calculators and things?
So in terms of income multiples, whilst they exist, we have started to look at relaxing those now. So in the background, where the case warrants itself, we can look at stretching that out. I suppose one of the key USPs of ourselves is that manual underwriting approach. So we're able to look at a case on a case-by-case basis, look at what the actual incomings and outgoings are, and seeing how we can help get the client the best borrowing potential that they've got. I think it's a slightly outdated way of looking at things, 4 times income, and that's where you max out. And I think we'll start to see more innovation around that, more challenge, and we're going to need to do that alongside sort of the landscape of house prices house prices are outstripping income. So there's got to become a point where we start looking at things in a little bit more of a pragmatic way.
Okay, yeah, it's good. Charlotte.
So we have an affordability calculator, as you know, so we base it off of affordability. And I would say that the credit score kind of gives you that decision, but we can lend up to 5 times income. Again, that hasn't really changed with Precise, so I haven't had that experience where we've restricted multiples at Precise, and ours is always on an affordability basis. You know, so if they're clearing commitments and they say they're clearing commitments, we're quite happy with that, and we'll disregard them for affordability. So as far as Precise is concerned, we haven't really restricted our multiples. It's always been on an affordability basis, and it can be up to 5 times. And in my opinion, that's quite generous.
That's good, thank you. And Mark, what about you?
I think income multiples is a bit old-fashioned way of kind of looking at things. I think kind of to echo a bit with what Dan was saying about having an underwriter who will go in and kind of manually look at cases and stuff. That should be the way everything kind of gets looked at moving forward. And I think there's still probably a bit of a risk assessment being done by the industry at the moment, and making sure that everyone is kind of comfortable before any big changes kind of happen around removing income multiples or modifying people's kind of affordability, as there is still kind of that confidence and making sure that everything is going to be okay. But personally, I think next year we'll see some really exciting things along those fronts. I think it's been a hot topic for people for a long time, and without saying too much, I definitely feel like we'll see some change on those fronts, especially from our lenders' perspective.
We've been trying for 10 years to get changes on this sort of thing, so it'll be impressive if 2022 does succeed in that entity. So especially with regards to how much people are paying rent, especially down here in the south. The cost of renting compared to the cost of a mortgage, so disparity. It's just crazy for first-time buyers, especially. But there we go. So hopefully we'll see some innovation in 2022. That's what you're saying, Mark. Yeah.
I'm hoping so. Yeah, absolutely. I think from an industry perspective, like it's overdue.
It's a need.
Out there, Dan. Yeah.
It's a need, and literally 7 out of 10 of every single one of our inquiries coming through the front door here are for first-time buyers who are struggling to get on the property ladder. So something needs to be done, without doubt. So, and talking of underserved markets, we've got contractors as well. So, Charlotte, do you want to start off on how you can assist contractors? Because again, that's another part of the market that's definitely on the increase since COVID.
It certainly is, and I'm certainly seeing a lot more inquiries now. That are complex incomes, a little bit of layering involved, perhaps. Are there umbrella companies involved? Are they an employed contractor? Or are they self-employed contractor? Look, the way that Precise look at it is it can be quite simple. Essentially, who's paying the tax? So when you've got a contractor, we don't have a day rate contractor policy or anything like that. But if you are a fixed term contractor, and let's say you've got 6 months or more remaining on that contract, and it's an employed basis, provided that you've been employed for the 12 months before the contract began, then we're good to go with whatever that contract is. So we're good with that. If they're a self-employed contractor, so they're not actually paying their own tax, then we would treat them like self-employed. So we'd need to see 12 months. So again, the minimum 12 months trading for those. With umbrella companies, again, it's who pays the tax, who are they actually employed by, but it would either go one way or the other. They're either employed or they're self-employed, and I would say in those sorts of scenarios, definitely have a conversation with the BDM, perhaps send a copy of the contract over just so they can cast their eyes over it, make sure that there's no kind of third parties and bits and pieces involved that we need to be aware of. But yeah, that's kind of where we sit, either employed or self-employed.
Great, thank you. Dan?
Yeah, contractors is another one of our secret weapons, I like to say. So when it comes to contractors, we take a very simple approach. We're looking for 12 months experience as a contractor, not necessarily on the same contract or even a similar line of work. We need 3 months left on the contract at the time of application. And then in terms of how we treat that income, if they're professional contractors, so
Good, thanks. Mark, anything to add to that?
Yeah, so I think we've all kind of said they're all pretty good with contractors. So from a day rate perspective, we've always been really, really flexible. So considering day one contracts for day rate contractors, from an affordability standpoint, it's the day rate times 5 times 48. So again, it's better than some of them out there who are doing it by 46. We can look at up to gaps of 6 months in between contracts as well. So that's obviously a really big one, and especially with some people might take 6 months as a whole, or whether that is kind of 2 months here or there. As long as there's no more than 6 month gaps in a 12-month period, we're always kind of going to be comfortable to look at these types of cases. So kind of echoing what everyone else has said, we're flexible with it as well. Contract cases, a bit of adverse, by all means, this is what Bluestone likes to do.
Brilliant, thank you. And we're fast running out of time here, so I just want to touch really quickly on AVMs, valuations, desktop vals, and so on. Very much in the forefront of all of the specialist sector, I would say, at the moment. How are you finding things? Is it speeding things up? Are you finding down valuations? Are you finding disparities between the valuer going out and a desktop valuation? What's your views on this, and how is it helping the scenario currently? I'll stay with you on that one, Mark, please.
Sure. I think it's great. I think this is especially for Bluestone. It's been something that was one of the positives that we've taken since the beginning of the pandemic, is kind of enforcing an AVM policy, and having the ability to kind of get these done at the click of a button. I think it's been brilliant, and ultimately, I'm sure everyone would agree, if we can get to an area where physical valuations are almost no longer needed, everyone would have a much kind of happier and quicker mortgage experience. We're probably still a long way off of that yet, but it would be good if we can get there. I haven't actually come across any serious issues with these with AVMs and implementing the process. I've not seen any cases where it's been, say, down valued on an AVM, and then they've questioned it, we sent the value around and it's gone up massively. Like, I haven't seen any of that. I guess that just kind of is testament to what we will look at on an AVM basis, and what we won't, is making sure we're looking at the right things, and we're not just taking what the computer says as gospel, because we don't do that from an underwriting process. We don't do that from like a credit scoring process or anything like that. So we're not making the computer make the decision at evaluation stage either. But ultimately, AVMs are great. I think they're brilliant. I think they've been a huge help for Bluestone, and long way to continue.
Good stuff. Thank you, Charlotte.
So at Precise, you'll know that we actually do physical valuations, and we have returned to physical valuations certainly since the valuers have been back out on the road. We did do desktops and AVMs whilst the valuers weren't able to get out, and as you're probably aware, now we're part of the One Savings Bank group. We've also got our experts in our real estate team that are massively helpful. But we have returned to physical valuations, and I think we are talking about other options. I'm sure we will continue to look into our options, because as the team sort of expands and things return to some normality, I'm sure with valuers heading out to properties at the moment, last minute cancellations, I'm sure we've all experienced those, through positive tests and things like that, which are very frustrating. Yeah, I think there will be, there needs to be a solution for those sorts of things. I think the conversations are still ongoing, but we are committed to the physical valuations at the moment, certainly on the long-term perspective.
Yeah, I think that, and you're right. I think you picked a very valid point there. We're finding that with other companies where they may only have one valuer in that area, one surveyor in that area, who's just had to isolate or got COVID themselves, and therefore they're delaying the valuation by 3 or 4 weeks while that rectifies itself. But there's no one else in the area to come in and take over, which can be quite frustrating. So yeah, you're right. There needs to be some sort of scenario to account for those accommodate for those sort of scenarios. Dan, over to you.
Yeah, so AVMs are very new to us. We've only just recently launched, and I suppose we're in a period now where we're trying to get our funders comfortable with it. Where we've seen where we've seen it go through, we've been able to put cases to offer in 1 working day, which for a specialist lender like ourselves years ago would have been absolutely unheard of. So we're really excited about it. I guess when it comes to down valuations, it depends. If you ask the valuer, they'll probably tell you there's no such thing as a down valuation, and that a property has got one value, and that's what it comes back to. And I think in terms of the valuation sector, I think we're going to see, and surveying, I think we're going to see some real innovation over the next couple of years in this space. And I think we're going to have to, because we sit alongside a backdrop of the average age of a valuer being closer to retirement. We're going to see a reduction, and people not necessarily wanting to go into that industry. The only solution is going to be looking at utilising those data points, looking at utilising the surveyors that are out there, and maybe looking at more of a hybrid approach. So I think it's obviously won't be just round the corner, but I think we'll see lots of innovation, which will help us speed up the client's journey over the next couple of years. Touch wood.
No, I think it's a really good point. Just so I did a dip with Pepper this morning actually, and the dip actually came back with no valuation required AVM done. That was brilliant. So well done to you guys on that one. Well done to you guys. If I can do it, then there we go. That's impressive.
And everyone can.
Absolutely. So talking to tech, what have your individual companies done that's really increased? You've seen a marked increase in the way you process things, or something that's really come to the market over the last 12 months. What's been really good for you guys? And Mark, let's start with you on that one.
Well, AVM has been huge. I know we just kind of gone over that. From a tech perspective, I wouldn't say too much has changed from our kind of front. What we probably look changing more is kind of processes and the way we operate and getting cases into underwriters and stuff quicker. Updates to requirements and bits and pieces. We've always had a pretty good kind of system. It's never really drawn us too much flack, and we've just kind of gone down the route of looking at doing identity tokens as well, which I think some people might be aware is that new kind of government-backed scheme which enables people to use like a one-track system for ID verification. Get my words out, which is actually a really good and useful thing. But we've always kind of thought we were on the forefront of technology for the most part anyway. So don't get me wrong, we've always got continuous development things in the background, but we haven't needed to make too many technical changes to kind of maintain our market share of the business or adapt into a post-COVID world.
Okay, no, good. Thank you. Charlotte, what's changed? What's good?
I think we're always constantly reviewing. I think most of us are. We want to improve our systems. We want to improve our process. I think from a technology standpoint, we've got the broker journey team. So it's a steering group that meets once a month. They have different conversations. They talk to brokers. They talk to customers about their interaction with us. How was it? How could it be improved? I think they've been running for about 4 years, but I think one of the biggest things that we've seen is the online criteria guide, which came out of that group now. So if you have got questions around criteria, you can pop onto the online criteria guide and have a look on there and see if that answers your question. That's constantly updated. So, as a team of BDMs, we talk quite often, and we will say, I'm getting loads of questions around this now, and I'm getting loads of questions around that now. Perhaps there needs to be something on the online criteria guide. So just having something readily available that the brokers can refer to get answers to their questions, I think is really important. In terms of our credit scoring system, you may have noticed we did a bit of an update recently to our credit scoring system. So we're now getting some more instant, up-to-date sort of credit file data. So that's a little bit of a change, and probably more to come, but I'm not allowed to say too much about that. But yeah, certainly constantly reviewing and looking at improving is probably where I'd go with that.
Great, thank you. Dan?
Yeah, I think tech's exciting. I think if the pandemic's done anything, it's really spearheaded or set us on a course for some change that we've needed for a long time in this industry. But for us, I guess the key ones have been the introduction of AVMs and downstream. It'll be things such as open banking, integration into systems like mortgage apply, etc. And that diversifies my role as well. So on a day-to-day basis, I deal mainly with the clubs, networks and specialist distributors, but I also look after the core relationship with most of the tech firms that we integrate with, and it's now looking at that full cycle and how we can really help to drive innovation forward, I guess, and really speed up that broker and client journey.
Yeah, some really good systems out there with regards to the information tech and all that sort of stuff. Yeah, there we go. With regards to tech, etc., and so on, will we ever get to that point? Mark, you mentioned ID. We've tried many years. We've tried to try and get the same application form being used. The same ID is now a project that's across the market. Is everybody going to use the same ID when at the moment not everybody will use the same credit reference agencies, or they won't use the same application forms, and so on and so on? Is that actually ever going to happen? I know there's lots of projects involved in it and so on, but is it actually going to be a reality where all three of your lenders there will accept the same ID from someone right at the outset, going all the way through right to the end? Mark?
You know, it could happen. It's one of the things where, touching on the kind of the credit file thing, it would be great if we had a standardized credit file that everyone would work from. It would be great if we all had a uniform process. I think we all know that probably would be the best way forward for the industry. It's just it's never been that way, and change like that is so monumental. I think it would take everyone sitting down and talking about it for years continuously to come to some kind of agreement with it. From a personal perspective, I would love to see it. I really would. I think it would make everyone's life so much easier, especially when you got brokers who only get Equifax, and then we use Experian, and then they come to us and it doesn't quite tally up. I mean, that must cause no end of frustration for brokers, right? And it's all completely avoidable if everyone who is in charge sat down and went, well, what could we really do to make this so much easier? I personally, like I said, I'd love to see it. Whether or not we ever do, I don't know.
Dan, Charlotte, anything else to add on that?
I think it'd be fantastic if we could, but I suppose what it boils down to at the end of the day is each of these individual providers is a commercial entity in itself. So maybe the way forward and the way of fixing this is going to be portals that almost push out and touch base with all these separate places and pull back in whatever our preferences might be to work alongside.
Cool. Okay, good. Time has run away with us. So for the next 30 seconds, each of you, can you just let me know, what do you feel is the future for 2021 with regards to mortgage advisors and also the specialist lending area that you participate in? Dan, let's start with you, please.
So the specialist market, we feel it's set to grow, and it's we look at next year's targets and aspirations, and we've got real great hope for growth in this market. I think in terms of brokers, I think it's going to be about making sure that you find as many opportunities to touch point and embrace technology with your clients as possible. I think the days of the customer picking up the phone and saying, I think the mortgage is due for renewal, are going to dissipate. I think we're already at risk of those lenders with direct channels touching base with our customers. So it'd be definitely one of my top tips would be to definitely look at your CRM strategy and look at ways in which you can touch point with your customers at points which are prominent, not just at the end of a product term, for example. And there's lots of solutions out there in the market for that.
Good stuff. Thank you for that. Charlotte?
Well, I certainly think for 2022, we're going to see the specialist market increase. I think the need for advice from brokers around what options are there for clients is going to grow. I think we're going to see certainly the buy-to-let remortgage market, because we're coming up to sort of that remortgage, that 5-year period post-change. I think we're going to see lots of remortgage towards the beginning of the year. And I think the need for education for brokers has never been more important. So I would say, touch base with your packager firms, touch base with your BDMs, different lenders, and make sure you know what they're doing, and make sure that you're in the forefront of the BDM's mind, so that they contact you with any changes or improvements.
That's good points. Mark, over to you.
Yeah, I mean, Dan and Charlotte both said it. I think we can all agree the specialist market is going to increase massively. The true costs of the pandemic and the way things have changed, it's still coming to a head. So it's only ever going to get bigger. But I think ultimately, from a broker perspective, it does go down to making sure you don't shut the door on any case that you never would have felt comfortable with previously, or a new type of customer. And yeah, just embrace the change that's coming. There's some really good criteria, and there's so many kind of good lenders and stuff out there. I think Charlotte said it earlier in one of her points. There generally seems to be a lender for every customer. So a good broker will find that lender. And if you're not sure, do work with your packaging partners. Do work with people like yourself, Dow, and because ultimately the end goal is we want to help customers, and we have to do that as a team. And I think that's the most important thing, is we communicate what everyone wants to see from the industry, and make sure we help as many people as possible. So the bottom line is keep that door open, and speak to as many people as possible, and educate yourself and educate others with their opportunities.
Brilliant. Thank you very much, three of you. I really appreciate that. And 3 great lenders there. You can access them all through the Impact Guys. Give us a call, go through any inquiries. It is only one application. There's only one dip through our system to access everybody on the call here. So thank you very much for watching. We appreciate you taking the time out to see this, and I hope you've got some valid points to take away. Keep an eye on your emails. There will be other ones of these coming shortly. In the meantime, keep safe, stay well, and we'll speak to you soon. Thanks for watching.